You have a mortgage against that property. When you go to another bank and you want a loan, what's the first question they ask you? Are you a homeowner? You say, oh yes, but you're not a homeowner. The bank owns your home. They own 125% of your home. And yet, by ticking that box, by having a mortgage, you have access to more loans. This is crazy. This is what has happened. Instead of course, the loans being based on wealth or income or something tangible, it's being based on the home which you don't own. And of course, mortgage borrowers, in taking on, I mean, there's a supply of mortgages and demand for mortgages. There's two sides to this coin. They also were gambling that property prices would keep on rising. Although in America, they handed the keys back. The bank becomes the owner of a property, which is the last thing they want. And so speculation on the upside, appreciation, means the following. That really, in conclusion, everybody was taking risks. Financial institutions in what we've heard already. House buyers in taking on these mortgages, so it's supply and demand. Bets do not always pay off indefinitely, as we've seen in Japan's case. And the rest, of course, is obvious now. This was all spread across the world. So really, you saw the same points earlier from Stuart. So if you think it's his fault or her fault, in a sense, we've all got a role to play in this, in that we would like to see our properties rise in value. And in that sense, buying and selling, buying and selling, buying and selling causes that bubble. But that's history. We are where we are. Hello.
Jim, there's one thing that I have in my mind, but I haven't really seen that much, isn't it also that too hungry investors, and I'm using investors as a broader term?
Yes.
At the end of the day, the bank doesn't do it for a loan.
Yes. Yep.
The investor that pushed down into this bubble,
yep,
as well as that homeowner was an investor with, oh, it's easy money, I can gain 3%.
Yep. Thanks for bringing me back to that point. I should have raised. I just alluded to it very briefly. Let me now emphasize it. I said dividends. Dividends. Which financial sector of an economy requires sustained dividend payouts? And I'll give you a clue. If populations are aging in the West, which organizations need not only sustained dividends, but growing dividends? Pension funds. And that's your point. That the hunger for dividends has also been driven by the fact that we have a pension crisis building up in the West. And many other parts of the world, particularly the West. And you're right. Absolutely correct. This hunger for value. And we have not solved that problem. In fact, we've now got a crisis, even bigger crisis than we had before the last 2 years. So thank you. So let's look at the global economy generally. I've just tried to capture all the main sort of reports that are coming out to give us a sense of consensus at the moment. So the good news is this so-called perfect storm has passed over. We can breathe a small sigh of relief. The worst has abated, thank goodness, in the last 3 months only. This is really on a tenterhook, but we believe the worst has passed over. The confidence indicators around the world are showing recovery. You know, the indexes that Stuart talked about, business confidence, consumer confidence in most countries, but not all. We're literally at the turning point right now. We thought in the last quarter the UK would have positive growth. It didn't. So we now think the next quarter it'll be positive. So we're just at that turning point. There will be a turning point. And many countries have turned the corner. So growth is starting to come back, but not so dramatic in many cases. And financial markets have improved. Okay, the stock market is only one indicator. I'm not going to exaggerate that. That's future profitability. I mean, if you can't make profits at the moment, if the banks can't make profits, then they shouldn't be in business. They've widened their margins. They're very risk averse. They've got people hungry for loans, so they're doing very well, and they will do very well, and many other organizations. But sentiment has improved. That extreme, that credit crunch is beginning to diminish week by week. Still a long way to go, of course. The other global phenomenon is global inflationary pressures have been really almost non-existent globally. And the reason is very obvious. The scale, the extent of spare capacity that is built up in this recession has created, so much capacity that even companies, as they start to produce again, there's no pressure on wages and other costs at the moment. Now, that's a hint about the future, of course. There will be a short-term rise in inflation in the coming year, for oil price reasons.
Just to segue from that, how much was I still sort of have a belief that a lot of this was company-driven, meaning that the companies use this crisis in order to clean house.
They always do.
Exactly.
In every recession.
But how much of that can be attributed to coming out?
I wouldn't consider it. This is not just a short-term blip where companies want to clean out their workforce. This has been structural. This is structural. But you're quite right. In every recession, we get rid of quote-unquote surplus workers. Maybe we shouldn't have had so many in the first place. So there will be an adjustment, as always. No question. But this one is structural. This one is severe. But we're coming out of it. The spare capacity has been significant. And of course, the inflationary pressures at the moment are fine, but they will be coming back in the future at some stage. Having said that, central banks are not stupid. Well, sorry, most of them aren't stupid. Central banks know that the scale of liquidity that they've injected will at some stage start to create inflation. They know that, which is why in the coming year or so, or 2 years, they will start to siphon off that liquidity. And there's the danger of the double dip. They will not turn the taps off too quickly because we're not yet on a sustainable growth path. It's going to be very finely balanced, month by month by month. There's no sign of it being turned off yet, by the way. But they will at some point in the future. US economy, let's say a few words about that. Officially, the recession ended in Q3. And actually, quite surprising. The growth that the US reported in Q3 on an annualized basis is equivalent to 3.5%, which would put America back on its solid long-term trend over the last 15, 20 years. Maybe even a bit higher than the trend, actually. Of course, that may not be sustainable. For the reasons I've said, the taps may be turned off, taxes have to go up and so on. Will be going up, are going up. But this was accepted. This is well above expectations, and of course, stock market has reacted very positively on the back of that. Of that 3.5%, 2.4 percentage points were the consumer. Again, not too surprising. If you remember, they've got this so-called cash for clunkers, the scrappy scheme for cars. But that all comes to an end, and